This is Professor Hazara again, and this is really a continuation of the module on consolidation subsequent to acquisition. And this example actually is going to be very similar to the other examples that we did. The other example, but there was two examples in that worksheet. The example we did. The only difference is that this one is going to be sort of like an abbreviated example. In the examples that I did on the videos and that you had to do for homework in a sense, you had to do the equity method. You had to do all the calculations. Then you did the equity method on the parents' books, and then you prepared the parents' books using the equity method. And then once the parents' books had been prepared after the equity method had been used, then that's what you consolidated. When you take the CPA exam, and in real life sometimes, the assumption is made that the parent is using the equity method, and the person doing the consolidation knows that the parent is using the equity method and knows about the equity method. That's why we did those examples. From here on out, and all the consolidations that we do from here on out, what we're going to do is we're just going to do the equity method calculations and assume that the parent has already used the equity method. So we're not going to do the equity method entries and then prepare the parent's statements using the equity method. We're just going to assume the parent has already used the equity method and that the parent's statements already reflect the equity method. Okay, so let me show you what we have here. In this example, it's you can see the text. This looks like a typical text we have. We're going to do a goodwill computation. We're going to do income from sub. We're going to do the incomes from sub, the investment. Those are all the equity method things. What we're not going to do is the equity method journal entries and the preparation of the equity method financial statements. We're assuming that's already been done. Okay, so once we get through the investment account, we're going to go straight down into the consolidation entries and then straight down into the consolidation. Okay, now what I'd like to emphasize is a couple things. Number one is that this is a 2-year problem. So this is a problem in which the consolidation is being done 2 years after the date of acquisition. So this company will have been acquired on January 1, 2011, but the consolidation is being done on December 31st, 2012. First thing that I want to emphasize. Second thing is, let's go down to the consolidation here. You got to get used to looking at consolidation worksheets. So this is your consolidation worksheet here. And this would be what was in the box in the other two examples, but we're not getting that extensive here. We're just going to do the consolidation straight out. Now there's 3 numbers in the consolidation there. Well, there's a bunch of numbers that are important. Income from sub. First, let's take a look at the parent's financial statements. Income from sub. Since the parent has income from sub of $86,000, since there is an income from sub, the parent has used the equity method. If not, it would be 0 because incomes always would have been close to the parent's retained earnings. But the parent had income from sub of $86,000, and also the parent has an investment account of $772,000, which was obtained using the equity method. So there are 2 accounts here in which that are the result of the equity method, and we assume that the parent has used it, and obviously has, and that you know about it. Okay. The other things I want to stress is that here are the subs financial statements. These are the subs financial statements, and in any consolidation, what's going to happen is a lot of times on the CPA exam, you'll have to do a consolidation, but you'll have to pick certain numbers off the subs financial statements because, for example, subs net income, their basic net income, is right there. And I'm going to put these in red, the ones you're going to have to pick off. You're going to have to pick off the income, the subs income, to do the calculation for income from sub. Next thing is your beginning retained earnings. In the investment account, we always use the beginning balances that were in the investment account. Those are the beginning retained earnings for the sub. And the final thing is, that in the investment reconciliation, we have to deduct the dividends. And so you're going to pull those dividends from the subs 2012 statement of retained earnings. So what I'm trying to say is, you're given a lot of numbers in some problems, but when you're asked for a number from the sub that you have to use. That's a product of the sub's accounting system. Pull it from the sub's financial statements and the consolidation. You cannot go wrong. Okay, so let's go ahead and start the problem. So we come up here. Here's the text, the problem. Pan acquired 100% of Sal Corporation outstanding voting common stock on January 1, 2011 for $700,000 cash. Typical stuff. All cash, simple. The equity on January 1st, 2011 was $300,000 capital stock and $300,000 retained earnings. So you're paying $700,000 for all of a company's equity, which is worth $600,000. Okay, which is obviously the difference is going to be $100,000. Now the difference between the price, the $700,000, and the underlying equity of $6 is going to be allocated. Sal is going to be allocated $30,000 to Sal's undervalued inventory. And remember that undervalued means that the fair market value is greater than the book value, and the remainder to a patent with a 5-year life. So it looks like there's no goodwill here. Okay, I'll put the numbers in now, and you'll see there's no goodwill because it says the entire amount was allocated 30 to inventory, and the remainder, which means basically the entire remainder, to a patent with a 5-year life. And then the undervalued inventory items are sold in 2011. Okay, so, and then the separate financial statements are shown in the consolidation. That's where you get the separate financial statements. The separate financial statements are shown for 2012. They're shown right here in the consolidation. Okay, and you know that the parent's financial statements are their post-acquisition financial statements. Okay, so let's do this. Let's go ahead and start. And it really is, in a sense, an equity method problems without getting into all the detail of what we're looking at. Okay, so the cost of the company, $700,000. We know that. Their equity is going to be their common stock is going to be equal to, and we're going to subtract it out as usual, the sum of their common stock of $300,000. Let's put them in there first. Common stock is $300,000. 300,000, and the retained earnings are 123,000. Okay, so what we're going to do is, like we usually do, we're going to subtract out the sum of the equity account, which is common stock plus the retained earnings. I'm going to put a negative there. We're going to take it times the parent's ownership percentage of 100%, and let's put a negative in front there. Okay, so you're paying $700,000 for something worth $600,000. Here's one issue: is why am I multiplying this times 100%? Because I want you to get used to the idea that in very short time, the consolidations we do are not going to be 100% acquisitions, but they're going to be 80 or 90% acquisitions, which is called a controlling interest, because you control a company, and there's going to be a non-controlling interest of maybe 10 or 20%. And you've got to do the accounting for that too. So I want you to start getting ready for that type of thing. Anyway, so the total overpayment is obviously $100,000. Now, according to the problem, inventory is overvalued by $30,000. Now, this is undervalued by $30,000, which means that the fair market value is greater than the book value, so you subtract it. Okay, so we're going to take out inventory all at once because it's a current asset, and the patent is the remainder of the difference, and the patent has a 5-year life, so that we're going to run off 14. And I'm just going to, just for posterity's sake, I'm going to make that 0, so we can work it all the way down. So there's our goodwill calculation. We paid 7 for 6. Difference was 1. According to the text of the problem, 30,000 allocated to inventory. That's going to that will be written off, or maybe has been written off over 1 year. And the patent was allocated the remainder, which is 70,000, and that's over 5-year life, so it's 14,000. Okay, let's come down here to the income and investment calculations. And it is all so important to get the key numbers, some of the key numbers here, from the subsidiaries financial statements on the consolidation. Okay, so let's do this. You know this is, I put 100% up here just because it's a 100% column. Pretty soon we're going to have columns for 90% and 10% when we have controlling and non-controlling interests. Anyway, so net income. Net income is, the sub's net income is equal to, let's go down here. the subs net income is 100,000, and it's their 2012 net income. All these statements here, these two statements are for 2012. This is 2012 consolidation, so the 2012 net income is 100,000. Pick off the net income, beginning retained earnings, and dividends from the subs financial statements. You cannot go wrong. You don't have to be doing calculations or anything. They're done for you by the sub. Okay, so let's put it in 100% here. Let's see if that works out. Okay, so the pre-adjusted income, your share of the pre-adjusted income is 100% of 100,000 or 100,000. Okay, now the patent. Now, what are the things that we could take out here? We could take out the inventory or the patent. The problem with inventory is it was taken out in 2011. Notice the text of the problem. It says, I don't know if it says it or not. Yes, it does. It says 30,000 is allocated to inventory, and that undervalued inventory items were sold by the subsidiary in 2011. So that was subtracted from net income and taken out of the investment account. Excuse me. In 2011. So that all means we only have to worry about the patent. And this really would be the second year of the patent's amortization, because remember, it has a 5-year life. The first year would have been taken out in 2011, and now 14 is going to be taken out in 2012. Okay, so we'll do this. Okay, so our income from sub is 86,000. I'm going to make this 0 just to work the whole thing down. Our income from sub is 86,000. And once you get your income from sub and your investment accounts, match them up with what is in the parent's financial statements. There it matches up. So that means you're on the right track. Those numbers have to match, both the income from sub and the investment account. Okay, so now let's go back here and work the investment account. Now keep in mind that we split the investment account analysis up. Everything above this line is the balance as of 1/1 of the current year, the beginning of the current year. And then you're going to add 2012 net income, take out 2012 dividends, and then you're going to get your ending balance, your 12/31/12 balance. Okay, so we know that common stock is 300,000. And let me clarify this once again. We know that the common stock at 1/1/11 was 300,000. The assumption of this course is that there's no change to common stock. There's no issuances. There's no treasury stock. So we keep making that assumption. Okay, now we need, and I'm going to emphasize this. This is common stock as of 1/1/12. Now we need the retained earnings as of 1/1/12. Okay, and I'll even put the patent as of 1/1/12. Everything above that red 300,000 is as of 1/1/12. Okay, and you know how I got these. Just to remember, the way I got these was it's everything that's in the goodwill computation. Common stock, retained earnings. Inventory was in there, but is now no longer in there because it went in and out in 2011, and patent's the only thing left. Goodwill 0 anyway, so it doesn't matter. Okay, now your retained earnings as of 1/1/12. Where do I get those from? I'm going to once again emphasize, when you need something from the subs financial statements, go to the subs financial statements. So let's see what the subs retained earnings were at 1/1/12. Statement of retained earnings, that 380 right there. So the sub statement of retained earnings tells you that their beginning retained earnings, 1/1/12, 380. Now the patent. What was the balance of the patent at 1/1/12? We bought the patent, wrote it up by 70. We took out 14,000 last year, okay, which means that there is, and that's why I have this calculation here, there, as of the beginning of 2012, there's 56,000 remaining, which is 70 minus the 2011 amortization, which gives you 56,000. Okay, so your beginning investment balance was 736,000. Now all we have to do is add in our equity method income, take out our dividends, which, by the way, we're also going to take out from the parent statement of from the sub statement of retained earnings. and we should end up with our ending investment balance. So let's go ahead and add in our income from sub. Let's take out the sub's dividends, because remember that in the equity method, investment account is reduced by dividends. Let's go ahead and take those out, which are right here. And that's why I emphasize that at the beginning. Get the net income, beginning retained earnings, and dividends from those three places, the sub's financial statements. Take out 50. So our ending investment balance should be 772, assuming the parent has used a full equity method. And to me, it looks like it matches. So the parent has used, you've just proven that the parent has used a full equity method. So you don't have to go around, and those are the financial statements because they have those two accounts. So you don't have to go around actually making the entries. The parent has already used them. If you do the calculations and they match the income and investment accounts, the equity method, the parent has used a full equity method. Okay, so now let's go ahead and do the consolidation entries. And as usual, you're going to have the big three consolidation entries. And I'm just going to put this one in here, this 17,000 in. This problem I adopted from a text, and it just had a sentence in there. I just forgot to put it in, that the parent or the sub owe each other 17,000. So when you owe each other an account payable or note payable, you just have to reverse them out, because consolidations are viewing the entity as one, and you can't owe yourself money. But the big three entries, here's where the big three entries, and pretty soon they're going to be the big four entries. But here's the big three entries. The first entry is going to take you back from the beginning, from the ending investment balance to the beginning investment balance. The second entry is going to eliminate the beginning investment balance, and then you're going to depreciate your only asset that you're going to depreciate, which is 14,000 in patent. Okay, so let's do this. And all these numbers, all the numbers for these first two entries are going to come from your investment analysis. Okay, so we're going to take 86 out for income. We're going to take dividends out, make that a negative, because you can't have negatives. You can't have negative and positive numbers in debits and credits. The debits and credits are the negatives and positives. And then we're going to take 86 minus 50, and that'll reduce your investment account by 36. But notice what I've got here. I will have eliminated my income. I will have eliminated the subs dividends. And then when I take 36 out of the investment account, that 36 is the difference between that 86 and 50. I will have taken the investment account from 772 back to 736. So after entry number one, I'm at 736, and we'll look at it when I actually post these entries onto the consolidation. Next entry, it's all listed for you. We're going to eliminate the subsidiaries' equity accounts, because you can't have their equity accounts and their assets and liabilities at the same time. You'd be double counting. Okay, so we're going to eliminate the common stock. We're going to eliminate the retained earnings. And then the final debit is going to be, we're going to debit the patent for its beginning balance at 2012, which is equal to 56. So all my debits came to that amount right there, and they total to 736, which is I have a credit to the investment for 736. So that's going to actually wipe off my investment balance and make it zero, because there was 772 in there. Take 36 out. That's going to take you back to 736. And then finally, take the 736 out, you're back to zero. Okay, finally, the depreciation expense. And so as of last year, let's go back to this number right here. As of last year, during last year, you took out $14,000 depreciation or amortization for the patent. Call it whatever you want. Now we've got to take out, now another year's gone by, and that 56 only reflects the 2011 amortization. Now we've got to do entry number 3, which is going to record the 2012 amortization. And that's going to be for 14,000. And let's see if I can pick it off somewhere. I like picking numbers off from calculations, stuff like that. Let's pick it off of here, and we'll just make that a negative number. I like to pick numbers off rather than just writing them in. Okay, and then the 1717, don't worry about it. It's something that I would tell you on the exam. Okay, so let's go ahead and make sure that we're running here. So we got 853. So 853 is our total here. Okay, so our total debits and credits rate for 853. Now the only thing we've got to do is we've got to post those to the consolidation. Now I'm going to go ahead and let's call this, it's actually entry number 4. And entry number 4, just to get this one out of the way, is a debit to accounts payable for $17,000 and a credit to accounts receivable for $17,000. And all that is, that's just in the original problem. They owed each other 17, so you've got to just write off whatever receivable and payable are. Okay, but let's post the big 3. Posting these is very important. And I'm not always going to set it up for you, so let's go ahead and see. Okay, so let's do this first. First one is debit income from sub for $86,000. So we're going to go ahead and debit income from sub for $86,000. We're going to credit dividends, the sub's dividends for $50,000. The place you do that is where dividends are always found, which is on the statement of retained earnings. So we're going to credit dividends in entry 1 for $50,000. And the plug, just the difference, I'm going to use it as a plug or difference, is going to be to the investment account, because the difference between the income from sub and the dividends is the change in the investment account. So I'm going to take 86 minus the 50, and that'll give you that 36. That was the plug number. Just so take out your income, take out your dividends, and whatever plug is, debit or credit, something. Occasionally it's a debit, usually not. Then that would be your investment adjustment. Okay, so now we have reduced the investment account. We've taken 36 out of the investment account. And so if you take 772, take out these 2 items, take out 36, you end up with 736. So now we're ready to make the investment account 0. And notice one thing, by the way, and you'll see this, the income account will end up as 0. You have 86 minus 86 is 0. Okay, so let's go ahead and post the entry number 2. And be careful with this one. This is where these videos, watch them a couple times, because these things, even for easy ones, you got to remember the basic rules. You're eliminating beginning common stock, beginning retained earnings, and writing up the patents to their beginning of your balance. Okay, so common stock, this is entry number 2. So you're going to debit common stock for $300,000. Then that's their beginning common stock. Then you're going to come up here and entry number 2, and notice there's 380. Try to get the number from in the first place. We're going to debit the subs retained earnings, beginning retained earnings for 380, which eliminates those retained earnings, and we're going to write up the patent. So we're going to go ahead and we're going to write up the patent here in entry 2 by 56, which would be its correct end of 2011 balance. Okay, so we've got the debits, and now those debits of 300, 380, and 56 should add up to 736. So in entry 2, I'm just going to go ahead and post entry 2 here for 736. I have to move it down or something. Okay, that's fine. Good, yeah. So the investment account started at 772. It took out 36, took out 736. So the final investment account will be 0. Let me go ahead and format the cell there. Probably do this at the end anyway. Okay, and then finally, let's make sure that our debits and credits are adding here, by the way. Yep, 839 so far. Okay, and so it looks like we're good. And the final entry is that 56 is 70 minus 14, which is the same number as right there. But that 56 only reflects the 2011 amortization, because the company was purchased at 1/1/11. So we've got to record another $14,000 for the amortization. So we're going to have an entry 3 here. We're going to debit depreciation expense for $14,000. So we're going to debit depreciation expense. It could be amortization expense too, by the way. But the problem only had depreciation, so that's where I put it. And we're going to credit the patent for the 14 in entry 2 here. It'll probably already come out. It's like a template. It's already buried in the template. Yeah, 42,000. I'm gonna make this 0. Okay, so that's it. So let's go ahead and start adding across. Remember the process of finishing consolidation. Add across. When you finish the income statement, work down, put it in the statement of retained earnings. When you've got your statement of ending retained earnings, put it down your balance sheet. So let's go ahead and add up. 800,000 plus 400,000 gives you a company with $1.2 million in revenue. Income from sub minus income from sub gives you income from sub of 0. Should always be that number. Cost of goods sold is easy. Cost of goods sold is 400,000 minus 200,000 gives you that number right there, minus 600,000. Now I don't know why I left the line in there. Probably because there's some old non-controlling interest. Okay, so it looks like a depreciation expense is going to be a negative 110 plus a negative 40 minus 14. So your cost of goods sold is going to be 164,000. That makes total sense. Okay, and then finally, your other expenses are going to be 192 plus the 60, which gives you 252. Okay, and just to emphasize how this is calculated, it is sales plus income from sub, which is 0, plus the negative cost of goods sold, plus the negative 164 for depreciation, plus negative 252. So 184 is your final net income. And you know you're on the right track because, as I keep repeating, parents' net income will always equal the sub's net income. 184,000 is going to be it. Okay, now let's go down to the statement of retained earnings, and I'm going to change this to 0, just to emphasize how this all works. Some templates built into there. Okay, so you finish your net income. So the trick is you move across the income statement from sales all the way, and you move across, and then your income for the parent should be equal to your net income from sub. Once you've finished with that, bring it down to your retained earnings there. And this is like closing net income to retained earnings in Accounting 201. Okay, now we're just going to work across and down again. Okay, so your beginning retained earnings are 606 plus 380 minus 380. For those of you who need to review your debit and credits, when you debit an equity account, you're reducing it. So you end up with 606. So the consolidated retained earnings are the same as the parent's retained earnings. The income is the same. Now let's go ahead and take out the dividends. Okay, so this is going to be equal to 10,000 plus 50,000 plus a negative 50,000. I think it's going to be minus 50,000. If not, I'll change it. No, that should be plus 50,000. So that's 100, negative 100, minus 50, plus 50 gives you negative 100, which is once again equal to the parent's dividends. So as I said before, on any consolidation, the parent statement of retained earnings and the consolidated statement of retained earnings should be identical. Okay, now that we've worked across, let's work down. Once you finish your retained earnings, those are the retained earnings that you bring down to the balance sheet. There. And then finally, we'll just finish our balance sheet. And balance sheets are usually the easiest thing. Make sure that the investment account is equal to 0 at the end, by the way. Okay, so we're going to take cash of 54 plus 37 gives you cash of 91,000. I'm verifying my numbers here as I go along. Receivables is 90 plus 60 minus 14 gives you 133,000 for receivables. Okay, and there's no entries in these next, so it's just going to be, I can just copy them, but I'll just do it slowly. It's equal to 180. The other assets equal to 160. The land is going to be equal to 100,000. The buildings are 200,000 plus 150 gives you 350,000. So far, so good. The equipment is $500,000 plus 400,000 gives you 900,000. Okay, and so the investment account, let's make this straight, is equal to 772,000 minus 36 minus 736, which gives you 0. The investment account is going to be 0. I'm going to take that 0 out. I don't know what that's doing there. The patent is going to be, it's an asset account, so it's that debit of 56 minus the 14 gives you $42,000 left for the patent, and that looks like the right answer. And think of it this way: the patent is equal to the original 7 you put in minus $14,000 depreciation for amortization for 2011 minus $14,000 for 2012. So that's 1956 right there. Okay, accounts payable, 206 plus 47 minus 17 gives you 236. Other liabilities is the sum of these two. Common stock is the parent's common stock plus the subsidiaries common stock minus the subsidiaries common stock, because you eliminated that entry. And you've got 600,000. The retained earnings is brought down. Everything equals. So if the income's equal, which they do, go back up here. If the income's equal, if the statement of retained earnings equal or the same, and if your balance sheet balances and your investment account is 0 along with your income for some, you're fine. So that's it. And I'm going to do this example in class, and then I'm going to give you a slightly different example to do for homework. And then what we're going to be doing as we go along here is we're going to slowly be modifying this, add certain things to this consolidation, to consolidations. Anyway, so that's our first basic real consolidation problem. And happy counting and good election night. Thank you.